Continuing with topic 3, paper 12, we'll revisit applications of capital asset pricing model, CAPM, in paragraph 3.6. Now, how do we use it? Well, first of all, portfolio construction and rebalancing. And we're going to look at an example, revisit that example on rebalancing because it has come up in the exam. A portfolio with high betas would be suitable for an aggressive investor. So if you're aggressive, you want high returns, you're going to go for high beta stocks. Portfolio with low betas, that's more suitable for a conservative investor. And then the third point, the portfolio will need to be rebalanced when the portfolio beta moves away from the intended portfolio beta. And let's look at that example covering the last point. Portfolio is constructed with 2 shares. 1 million Hong Kong dollars worth of company A shares with a beta of 0.5. So that is a low risk investment. And 1 million worth of company B shares with a beta of 1. And that's the beta of the market portfolio. What should be done to rebalance the portfolio if the company A shares price doubles and the company B share price trebles and the share betas remain constant? Well, you should see that the company B shares are going to have a higher influence on the weighted average beta. So you're probably going to have to sell the company B stock. But let's work through the numbers. And it says what should be done to rebalance the portfolio if company A shares price doubles. Repeating myself. The answer? Well, let's look at the weighted average beta. We take the $1 million at 0.5 of a beta plus 1 million at a beta of 1, and we divide by the total portfolio value, which is 1 plus 1, 2 million, and that gives us a weighted average of 0.75. Now, you don't have to work that out. You can see it from the numbers as they're given. 0.5, 1, equal weighting, so it's middle 0.75. The new portfolio beta, well, the investment A, company A doubles, so it goes to $2 million at a beta of 0.5. Company B trebles, so it goes to 3 million at a beta of 1, and we divide by the total portfolio value, that is 2 million plus 3, 5 million, giving us 4 over 5, a beta, portfolio beta of 0.8. The beta has gone up. It's become more risky. So you're going to have to try and get it back down to 0.75. How are you going to do that? You will sell the higher beta stock, company B, and you will buy the lower beta stock, company A. And that's the type of answer that will be offered if such a question is set. Other applications of capital asset pricing model, market timing. So if you think there's a bull market coming, you should be investing in high beta stocks. And with corporate finance, the required rate of return, the discount rate that you're going to use to value an investment can be based on the capital asset pricing model reflecting the systematic risk of individual investments. Now, what is the limitations of using the capital asset pricing model? First of all, variability of beta. Beta is calculated using historic rates. We saw that through the linear regression practice that we covered earlier. And you're looking at the future in terms of future returns. So the beta may not be applicable to future performance. We just don't know, but we're using historic numbers. And you do have unsystematic risk exposure, or you can have. Now, the capital asset price model states, these are the underlying assumptions, that unsystematic risk is 0 based on 3 assumptions. That is, you're fully diversified. And that's the first point. Portfolios are well diversified, capital markets are efficient, and bankruptcy costs are 0. 3 assumptions underlying the capital asset price model, assuming 0 unsystematic risk. Just keep that at the back of your mind. Capital asset pricing model deals with one factor, and that is the market risk measured by beta. And we see that, I'm just parroting the first bullet point, top of page 3.20. Now, arbitrage pricing theory was developed in the 1970s by academics in the US, Chen, Roll, and Ross. And they said that they could take a more complex view of risk and return of a security by looking at a number of independent economic-wide factors. And they presented 4: surprise in inflation, surprise in industrial production, surprise in the default premium of corporate bonds, and shifts in the yield curve. So instead of just market risk, the market risk premium determining the return that is required, we have a number of factors, and they suggest 4. It can be used by sophisticated investors, but it is more complex, and the vast majority of users prefer capital asset pricing model. Be aware of the theory. If it comes up in the exam, you have to note that it's more complex than capital asset pricing model. And again, it is delivering an expected return for an underlying security. We then come to price to book ratio. So that's the price over the book value of equity of a company. It's a multiple. So if stock price is 10, then the book value of equity is 5, millions, trillions, billions, whatever. The price to book would be 2, 10 over 5. Now it's used as a value multiple for companies with significant capital on their balance sheet, such as banks, manufacturing companies, or airlines. Price to book ratio of a stable company determined by the difference between the return on equity and its cost of equity. So the higher your return on equity compared to the underlying cost of equity, the higher the price to book will be. If you were to think about investing in property, the return on equity is the rental yield on the market value of the property, and the cost of equity would be the mortgage rate, for example. Well, the higher the yield, then the higher the price of the property. Return on equity is a measure of profitability from a shareholder's perspective. Also, it determines a company's long-term sustainable growth rate, G. And the growth rate in earnings is return on equity multiplied by the earnings retention rate. So the more you retain in terms of earnings in a company, then the faster earnings will grow, just because you are feeding investment back in. Now, the relationship between price to book ratio and return on equity, it can be derived using the dividend growth model. We won't worry about any derivation, but the relationship that results is the price to book ratio can also be expressed as return on equity minus the growth rate divided by the required return on equity, that I beg your pardon, the cost of equity, RE, the cost of equity less G. And if you note at the bottom of page 3.20, if the return on equity is greater than the cost of equity, then price to book will be greater than 1. If return on equity is equal to the cost of equity, price to book will be equal to 1. And if return on equity is less than cost of equity, price to book will be less than 1. Intuitively, that makes sense. Do I need to know that for the exam? Unfortunately, those relationships, yes. Not every exam, but I have seen them as the target for a particular question. Top of page 3.21, if a simple linear regression model is run regressing price to book against return on equity for many stocks, you're looking for a positive relationship. That is, as the price to book goes up, the return on equity will go up, and flip it around the other way. For higher return on equity stocks, the price to book will be greater. Now you can see above and below the regression line. If you're above, the price to book is higher than you would expect for that return on equity. So it's overvalued, you would sell. If the stock has a price to book that's less than expected for that return on equity, then that's a good value. It's undervalued, and you'd like to buy that stock. Again, that relationship, be aware of it, very easy to examine. And those 2 points are just reflected in the bullet points underneath the graph. Now let's look at an example of price to book and return on equity. An asset manager runs a regression line on price to book of companies in the airline industry against return on equity, resulting in the following model. Price to book, that's the y-axis, is equal to 0.96, that's where the regression line crosses the y-axis, plus 9.28, that is the gradient of the line, multiplied by return on equity, that's the x variable. As it says, that is for every 1% increase return on equity, price to book increases by 0.0928. Remember that return on equity is expressed as a decimal. Asset manager now identifies two airlines following price to book and return on equities. Price to book 2.58 with a return on equity of 14%, price to book 1.86, return on equity of 12%. Should you buy or sell these airlines? Well, let's look at the top of page 3.22. Airline A. Given the regression line, the price to book should be 0.96 multiplied by 9.2 multiplied by, that should be 0.14, 14%. That works out at 2.26. Now, the actual price to book is 2.58. So the price in the market, 2.58 times the book, but you would expect using this regression 2.26. So the return is above the line. It's too expensive. Buying is not recommended. With airline B, plugging the numbers in, we get a price to book from the equation of 2.07. The actual price to book is 1.86, so it should be 2.07 times the underlying book value. It is actually 1.86, making it relatively cheap. Buying is recommended in that situation. Let's move on to the efficient market hypothesis, and you could easily get one question on this. Now, an efficient market fully reflects information about securities in their prices. That's what this is all about. So if new information comes on the scene, then the prices should change almost immediately on a stock market. And as I've said, new information quickly reflected in prices. The efficient market hypothesis implies that share analysis and active investment strategies cannot deliver better performance because the market knows best. The prices will change immediately. So no end of analysis will find you underpriced stocks. That's the theory. Efficient capital markets is an inherent assumption of the capital asset pricing model, and we saw that earlier. And there are three types of market efficiency: operational efficiency, informational, and allocational. What do these mean? Well, operationally efficient market is where the information from all over the world is transmitted to the market. So it's the actual transmission of the information is fast, it's efficient. Informationally efficient means that the information is quickly absorbed into market prices. And then allocationally efficient means that from that change in information, markets will allocate capital very quickly to maximize the present future capacity of the economy's capital. Very much theoretical. Now, the efficient market hypothesis specifically refers to informational efficiency. That is, prices of stock reflect new information very quickly. And three forms of the hypothesis, through lots of research, I'm sure, doctoral research in the 1960s, 70s, have come up with three hypotheses. The weak form hypothesis of the efficient market hypothesis, the semi-strong form, and the strong form. Very good chance one of these is examined. What is the weak form efficiency? We say that prices fully reflect all historical market data, both price movements and volumes. Therefore, it is not possible to make abnormal profit by using historical prices and volume data. And a conclusion that comes from that is technical analysis that's looking at past patterns of prices and volume cannot produce trading profits. The semi-strong form efficiency, here all public information is reflected in the price of securities, so that publicly available information cannot be used to beat the market. A conclusion from this is that fundamental analysis using information from a company's annual report and information about that company cannot produce trading profits. So the world of Warren Buffett doesn't exist. That's what the conclusion of the semi-strong form efficiency. Strong form efficiency says that all information, whether public or private, is reflected in the price. There, it's not possible to make an abnormal profit by using information about the security, any information. Now, a conclusion from that is inside information cannot produce trading profits. Now, the assumption there is that people trade on inside information. Well, in most markets, if not all, inside information or insider dealing is illegal. So the strong form efficiency should not exist. But if it did, the implications would be that technical analysts, I beg your pardon, the implications from all three. Technical analysts do not believe in weak form hypothesis. Otherwise, they would not be looking at charts. Fundamental analysts do not believe in semi-strong form hypothesis. They believe that the markets are not that efficient. And fund managers who believe the market is efficient will not pursue active investment strategies. The strong form efficiency, we can assume, does not exist. The random walk hypothesis, the last item for topic 3, paper 12. That is a statistical hypothesis, assuming successive returns are statistically independent. There's no correlation between the returns of one period and the next. So there's no pattern. Charts don't work. Distribution of returns in all periods is identical. That is, chance of gain or loss same in each period. It's a random walk. There's no way we can predict how the price will move given how it's moved previously. The assumption is share prices, which move at random, are unpredictable. However, studies have indicated the impact of specific events on share price behavior. Specifically, findings show consistent share price patterns in 3 situations. First of all, the January effect. Research has shown that January returns are consistently higher than other months. Turn of the year, New Year resolutions, all sorts of things. The Monday effect, people have found that Monday returns are consistently lower than other days of the week. And the small firm effect shows small firms earn higher returns generally than larger firms. Do I need to know this? Yes, has been examined. They may ask you which one of the following is not an effect that's of consistent share price patterns, or they could ask you about one of those. As ever, to prepare for the exam, a lot of technical material in topic 3, best to practice questions. And as I've alluded to earlier, and as is shown at the bottom of each of the pages, if you go to Examinator.online, go to the paper 12 questions, and you can practice for all 4 topics, including topic 3.